Hi folks, and welcome back to Meaningful Money. Okay, I'm still here in Lamorna and still freezing, so I'm going to crack on with this one. The light is fading as well, actually, a little bit. I'm going to talk about income protection insurance today. We've talked about life cover, we've talked about critical illness insurance, and this is the last of our useful protection benefits. So before we get into that, I'm going to thank my friends down here in the bottom right. That's Seven Investment Management, who continue to sponsor me here, for which I'm very grateful. Now I'm updating here episode number 20, an early one. It's not that I said anything wrong in that episode, but just the production quality is a little better now than it was, which it should be after 260 odd episodes. I've said it before in these videos, but your capacity to earn an income is your biggest asset by value. It's much bigger than the value of your house, probably. It's much bigger than the value of your car. If you add up what you're earning every year, multiply it by the number of years you reckon you'll be working, it's probably your single biggest asset is your ability to earn that income. Now, we insure our house, we insure our car, but most of us don't insure our capacity to earn an income. Just think of the impact it would have on you and your family if you can no longer earn money by working. So the kind of cover you take out to fulfill that is called an income protection plan. Now, here are the basics of it. Firstly, it's a term-based plan. It has a start and an end point. So it would start now, obviously, when you take out the policy, and it would end usually at state retirement age, but you can set it before that if you wanted to. The benefit you get from an income protection plan is regular. It pays out an income because it's designed to replace an income rather than a lump sum benefit. There is always a deferred period, which is a period of time which the policy waits until it begins paying you. So if I have an income protection policy and I go sick tomorrow, I can set the length of time that the policy will wait before it begins paying me. You can set that for 4 weeks, 8 weeks, 13 weeks, 6 months, a year, 2 years. And the reason you do that is because you may have sick benefits payable from work. And what you would do is you would set your deferred period to kick in after the work benefits fall off. Finally, just one more thing to say is that there are strict definitions of what it means to be unable to work. There are 3 ones, actually. The first one is you're unable to do your own occupation. In other words, you can't do the job you were doing before you became ill. Secondly, you've got own or suited occupation, which means you can't do your job or any similar job to which you are suited by virtue of your education or experience. And then finally, you've got any occupation, which means basically you're unable to do any work at all. Now, the best definition to get is the own occupation definition, because that's just means that as long as you can't do your job, it'll pay out. Whereas on an any occupation basis, you have to be unable to do anything really in order for it to pay out. Now, you can't insure more than the income you were earning before you went off sick, because it'd be great if you were earning 20 grand a year, set up an insurance policy for £100,000 a year and then just go on the sick. Well, it doesn't work like that. The maximum usually, that you can insure is about 65 to 70% of your gross income before you went poorly. But the benefits from an income protection policy are tax-free. So obviously when you're earning your income, you pay tax off it. And probably you're paying, depending on what rate of tax you're on, you could be paying anywhere between sort of 18-ish percent, maybe all the way up to 30, 40, 50%. It depends. But, if you're paying roughly 30% in tax by the time you add your income tax and your national insurance and stuff, well, you're only actually taking home 70% of your income anyway. And you can insure 70% of your gross income or thereabouts. It differs a little bit from provider to provider. Now, the likelihood of claim is higher than a life assurance policy or a critical illness policy, because you are far more likely to go off sick with a bad back than you are to die, right? The higher the likelihood of claim, the more expensive the policy is. And so income protection can be expensive. But, having a longer deferred period can help keep the costs down. But it's really, really important. If you can afford it, then it is really valuable cover. But again, take a view and balance your, need to eat and have a bit of a life. Balance that with protecting yourself and your family. It's probably the most underused type of insurance, but it's really, really important. So that's the sort of 3 types covered in some detail really. Going to need to sort of summarize the I for insurance part of our Simple Money program here, and look at what you actually now have to do, the simple steps you need to take to make sure you and your family are insured properly. So thanks for watching this one, and I'll see you next time for that.